Hello and welcome to the first lecture of a new section on basic financial concepts in this course, Finance and Accounting Fundamentals. So in this section, we will give you some in-depth view of basic financial concepts from accounting fundamentals. Now we are moving to finance fundamentals. Then we'll start by looking at the basic financial concepts. And in this particular lecture, we will look at four concepts: present value, future value, discount rate, and compounding. And these represent the time value of money. So, what is present value? What is the current value of the future cash flows discounted at specific interest rate? What is that and how is it calculated? Any thoughts? So this present value is the current value of future cash flows discounted at a specific interest rate known as the discounting rate. And they determine the value of in today's term, the value of the future cash flow. And the formula, as you see here, is given where PV is the present value, CF is the cash flow in a particular period. Let's say for simplification, if it is yearly, then CF1, CF2, CFN up to N years. R is the discount rate and N is the number of years or period. Now instead of years, you could have months as well. Only difference will be that discounting rate has to be done for the monthly basis. And there is annual discounting rate, there are monthly, and there could be a quarterly discounting rate also. Now, this concept is essential in fields like finance, investment, and valuation when assessing the worth of future earnings or obligations today. If you're likely to earn or you are required to pay in future, combination of those two in next 10 years, what is the value of that cash flow? You can use this formula PV to figure out that. So let's take a look at an example of the net present value (PV), NPV. In this, if you expect to receive cash flows in the next 3 years, $1,000 in first year, $2,000 and $3,000 in the year three, and the discount rate is 5%. Now, one way to simply look at is the total value of the funds that I'll receive over the next 3 years is 6,000. The question is it really worth the 6,000 rupees in today's term? Is the value of 3,000 in year three same as value or in today's terms of 3,000? Obvious answer is obviously no. So how do you calculate the NPV? So you start by doing this step-by-step calculation. You calculate the PV1, which is 1,000 plus the first year that you will receive, which is 1,000 plus 1.05 raised to power 1, that is 952.38. Then for year 2 you receive 2,000 and you divide by 1.05 squared and you get a figure of 1814, and like this for year 3, and you sum that up and you get a total value of 5357.95. So you see here the total value of these future cash flows discounted at 5% is 5357.95. This means the future cash flows of 1,000, 2,000 and 3,000 over next 3 years are worth 5357.95 instead of plain 6,000 when you discount at a 5% level. Now, if the discount rate is different, the NPV would be different. So that's how you see an example of an NPV. So let us now understand what is called future value, another concept of time value of money. And in terms of definition, future value is the value of investment after it has earned the interest or growth over a period. And let's look at and understand that a little better. So what is the future value? As we were talking, is the value of investment after it has earned interest or growth over a period. And it is based on a specific interest rate or growth rate, and it accounts for interest or returns accumulated over a given period. Now, so the future value, as you see, the formula is PV into 1 plus R raised to power n, where FV is future value, PV is the present value, the initial investment that you're making, and R is the interest rate, and N is the number of years. As an example, if you invest 1,000 at an annual rate of 5% for 3 years, your future value of that after 3 years, that 1000 be worth 1000 into 1 plus 0.05 raised to power n is equal to 1157.63. So that's how you determine the future value. Then let's look at the concept of discount rate. We have talked about discount rate. The discount rate is the interest used to discount future cash flows to the present value. Let's take a look at a little more detail. So it is the interest rate, right, used to discount the future cash flows to the present value, and this is known as the interest rate. And this rate reflects the time value of money, accounting for opportunity cost of capital, inflation, and risk associated with the cash flow. Now, how do you find the discount rate? So, first thing is to figure out the cost of capital, right? In that you need to, the discount rate is often derived from the company's cost of capital, which could be a weighted average cost of capital, WACC. And this rate represents the average rate of return that company is expected to pay to all its security holders, debt or equity combined. Then the second one is the required rate of return, in which if you are valuing a specific investment or a project, the discount rate could be the minimum return that investors expect, also called the required rate of return. The third thing that you need to take care is the risk-free rate plus risk premium. Now, in some cases, it is calculated as a combination of the risk-free rate, the government bond yield, and plus a risk premium to account for uncertainties in the cash flow. So that's another way. And lastly, discount rate can also be estimated by comparing similar companies or projects in the market. So obviously choosing the right discount rate is important, as it has a significant impact on the present value of the future cash flows as well as the future value of the present things that you have. A higher discount rate results in lower present value and vice versa. The last thing we'll look at is the concept of compounding. Now, what is the concept of compounding? So it is the process of earning interest on both the initial principal and the accumulated interest from the previous period. Now, this compound interest occurs when the interest is earned on both the initial principals and original amount and on the interest that has been added to principal from the previous period. Now, this leads to so-called exponential growth over time. Now, exponential depends on the discount rate that you take. If the discount rate is very low, the exponential growth rate also will not be very significantly different. Now, what are the key points of compound interest? First, there is a principal amount, right? The initial amount of money invested or loaned, like in this case P here. P is the principal amount or loan invested. Then there is an interest that is earned. And here there is an annual rate of interest that is earned on the principal and previously earned interest. And then there is the number of times interest is compounded per year. So compounding frequency. Now interest can be compounded at different intervals, daily, monthly, quarterly, annually. More frequently it is compounded, the faster the balance will grow. So in this example that you see, suppose you invest $1,000 at an annual interest of 5% compounded annually. So need to be very clear whenever you invest, how often is the compounding being done. So after 3 years, your investment would look like A is equal to 1000 into 1 plus 0.05 divided by 1 into raised to power 3. That is equal to 1157.63. So that's the power of compounding. So more frequent the compounding is during the year for a given interest rate, the faster growth of your principal will happen. So that's the process of earning interest on both initial principal and accumulated interest from previous periods. So what is next? What do we do next? So having looked at time value of money concepts in this lecture, we will look at the concept of risk and return, all the three, risk, return and risk return trade-off, in the next lecture. So thank you so much for watching this first lecture on basic financial concepts. I hope you're continuing to learn new things, continuing to enjoy, and I do look forward to see you again in the next lecture. Please feel free to message me if you have any questions. I'll be happy to answer your questions. And do download the PDF file to take a look at all those formulas and examples.